Losses accelerating as we head towards the close today. The S&P 500 now touching its lowest level since the summer back in June. Our next guest still finding opportunities amidst the September slump. Kevin Simpson of Capital Wealth Planning joins us now. All right, so we got a rough market, right? Dow's down 426, S&P's upset a bit, NASDAQ is too. Where's this opportunity to be found today? Because you seem to find it. Where is it?
Well, first of all, I think that the markets are taking their lead, taking their cue from the weather in the Northeast. It's cold, it's dreary, it's generally unpleasant. And I think for many reasons that are correct. We don't have that same bullish backdrop that we had for most of the summer. Uncertainty is putting pressure on stocks. And the Fed once again last week dug their heels in and said, hey, we're not lowering rates as quickly as you want. We're not lowering rates anytime soon. And that's giving us opportunities, Scott, because there are so many parts of this market that have been undervalued, not just for September, but really for the past year and a half. And it sounds a little bit like a broken record, but we're looking for companies that have dividends. We're looking for companies that grow their dividends and have low multiples, because that's how you can make money in a range-bound market. And that's what I think we're in, a market that's going to be range-bound. We're seeing a sell-off because Wall Street's digesting the reality, like it's finally setting in. The Fed's not kidding. Like they're going to keep rates higher for longer. And that weighs on multiples. It weighs on earnings. And maybe most importantly, Scott, it weighs on investor psychology.
Yeah, Bob, I mean, I'll play along with your weather thing if you want. I mean, it's going to be 75 and sunny next week here as well. So will this pass? Are bluer skies ahead for stocks, as people like Adam Parker suggests? Not out of the question at all that we could have a big run into the end of the year.
Yeah, I mean, I don't know that the big run was where my mind's at, but certainly the narrative hasn't changed. We're not at the precipice of falling off a cliff. It's just the Wall Street's finally digesting what the Fed's been telling us all along. And you need a bullish catalyst to move the markets higher. Maybe you get some of that from earnings. Maybe that is ultimately the Fed becoming dovish, quantitative easing, talking about rate cuts. And certainly that's not in the immediate future. But I mean, that's the catalyst that we've been looking for,
well, what about a chase?
For the past 2 years.
What about a chase from people like you who weren't prepared for, who haven't performed well and need to, and, missed it and want to get some of it before the year is over?
Yeah, if I chase anything or try to miss it, that's when you want to fire me as a portfolio manager. I don't style drift. I don't try to do any window dressing. We have a little position in technology. We have some Microsoft. We have some Apple. It did well this year. We've been writing calls on Apple. That's great. But we're rotating into the other names that haven't performed. And the best part about my style box, the boring, the aristocrat, the dividend payers, when they go through periods of relative underperformance, and it happens once every 10 years or so, they generally respond very favorably after that. So where I've been lackluster, negative, somewhat muted for the past year and a half, now I'm banging the table and saying, this is when you want to start allocating. You and I were talking about it just the other week, taking some of that profit from growth, putting it into fixed income, putting it into the dividend-paying stocks, these dividend growers. Because since the end of 1987, that crash in October, 50% of the S&P returns come from dividends and distributions reinvested.
Right.
So it's a theme that works, and the timing is now.